We start today exchange traded reference ETFs presentation. So let's get through the table contents here and let's get right into it. In the Australian market, exchange traded funds or ETFs have grown in popularity as an investment tool. There were like 223 exchange traded funds with a combined market value of $113.5 billion on the Australian Stock Exchange as of June 2021. ETFs provide investors with an easy and affordable alternative to investing in individual equities, allowing them to be exposed to a wide variety of asset class and investment strategies, both locally and globally. Therefore, this research comprehensive assess three ETFs list on the X, which are NVOL, OZR, and AUFMAU. The information is sourced on the Faxes and other reputable sources, including industry paper, academic literature, and public data that is specifically related to Australian ETF market. Now let's get right to the objectives and strategies. The purpose of this report is to analyze and compare the performance, characteristics, and exposures of three selected Australian ETFs using FactSet database. The report will cover the key characteristics, investment objectives, exposure benchmark, comparison, and performance metrics of the selected ETFs from the period of 2021 to 2024. The ETFs will be analyzed through descriptive analysis, risk assessment, and performance evaluation using Sharpe ratio and trading measures, ultimately providing informed investment recommendation. The purpose of this report is to explore the performance valuation of the ETFs in Australian market. Given the growing popularity and adoption of ETFs, it is important to understand how their performance can be measured and compared. These reports aim to address the key question: how can ETFs performance be measured and compared? Next, here we continue with the risk exposure of each ETF.
So as each ETF has diverse investment objectives and strategies, so this analysis will use figures such as revenue exposure and triographic revenue from FactSet to compare and then provide a key characteristic of the three funds. So the first fund, MVOL, employ a low volatility defensive strategy by monitoring an index of Australian stocks chosen for their reduced volatility compared to the overall market. So it is obvious that MVOL revenue exposure exhibits a balance across several sectors, with 30.70% from finance, 17.71% from non-energy materials, 11.51% from industrial, and 10.12% from consumer non-cyclical, and others such as healthcare, telecommunications, energy, consumer services. But on the other hand, OZR AU offer wide exposure to the Australian resource sector, which would suit investor looking for more focused exposure to this area. Moreover, their strategy is intended to offer a portfolio with lower expenses, precise tracking, and low portfolio turnover. Regarding revenue exposure, 68.63% of its revenue come from non-energy materials firm, while 26.71% come from the energy sector, including a distinct concentration on the resource sector. So as the AUMF AU is a multi-factor fund, it aims to check an index of Australian equities with favorable exposure to factors like value, quality, and momentum. Comparing this multi-factor strategy to a simple market cap weighted index, this fund aims to provide diversified exposure as well as enhanced risk-adjusted return. That is why its revenue profile is more diversified, with 33.52% from the finance sector, 22.19% from non-energy materials, and 8.4% from industrial. So beside these apparent differences, similarities could be seen in the figure of geographic revenue from MVOL and AUMF AU with 62.9% and 55.4% from Australia, while mainland China account for 35.9% of OZR revenue. Furthermore, the second and the third country that contribute to the revenue exposure of MVOL and AUMF are also the same, which are USA and mainland China respectively. On the other hand, OZR gains 17.6% of the revenue from Australia and 8.2% from Japan.
Thanks you. I will introduce three Australian ETFs, MVOL ASX, OZR ASX, and AUMF ASX, and analyze their volatility, exposure, and investment characteristics. According to the research result, MVOL AU has the lowest volatility with a standard deviation of 0.097 and a beta of 0.04, indicating the lowest sensitivity to market volatility. It has a moderate expense ratio of 0.3%, 99.64% allocation to equities, and its top 10 holdings compares 38.81% of the portfolio, indicating a balanced distribution of the other assets. OZRAU has a higher volatility with a standard deviation of 0.168 and a lower beta coefficient of 0.026, reflecting less correlation to market volatility, but higher individual asset risk. It has a higher expense ratio of 0.4% and a higher concentration of the top 10 holdings, which account for 82.76% of the fund, increasing concentration risk. AUMF AU has a standard deviation of 0.11 and a beta of 0.027, falling between MVOL-AU and OZR-AU in the terms of market sensitivity and volatility. Its expense ratio of 0.3% matched MVOL-AU. Its stock allocation ratio of 97.84% is close to MVOL-AU, and its top 10 holdings are more diversified at 36.58%. Additionally, MVOL-AU is heavily concentrated in the Asian-Pacific region, 78.23%, indicating a regional concentration that may expose it to economic or political risk specific to that region. However, the fund's market capitalization is more evenly distributed between large cap 58.23% and mid cap 33.85%, suggesting that the fund is less risky as these companies are generally more stable. OZR-AU is also concentrated in the Asian-Pacific region, 81.83%, with a higher exposure to large-cap stocks, 67.13%, which may reduce volatility but also limited small-cap stock higher growth opportunities. The fund has minimal exposure to micro-cap stocks, slightly increasing its risk diversification. AUMF-AU is more geographically balanced with significant exposure to the American 15.11%, reducing its reliance on the Asian market. AUMF-AU has a larger allocation to small-cap stock, 24.29%, which results in higher volatility and greater potential returns, suggesting that compared to MVOL-AU and OZR-AU, AUMF-AU has a more aggressive risk posture than MVOL-AU and OZR-AU. In short, MVOL-AU has the lowest volatility and market sensitivity for conservative investors. In contrast, AUMF-AU and OZR-AU have a higher risk and potential return profile for investors seeking growth opportunities. Next, by 7 introduce a drop rate benchmark. Thank you.
So thank you, Shikring, for introducing me. Now I'll continue with benchmark criteria. At first glance, they have some similarities. We filter and choose ETFs that are classified as equity and segment benchmark in MSCI Australia. They share the same ETF asset class at 5.0. So in this occasion, we use Trainer and Sharpe calculation. We did not implement the change, even though it is relevant to the subject. Sharpe and Trainer ratio are used to measure risk, adjusted rate of return. While they offer different ways to evaluate investment performance, Sharpe illustrates an understanding of an investment return compared to its risk, while the Trainer ratio explores the excess return generated for each unit of risk in a portfolio. The Sharpe ratio, or reward to variability ratio, is the slope of the capital allocation line, also known as CAL. The greater the slope, higher number, the better the asset. Sharpe ratio defines the risk in terms of standard deviation, which is a measure of total risk. Hence, it includes both systematic and unsystematic risk. Nonetheless, Trainer and Jensen narrowed the risk down to make it more understandable. Trainer ratio is an extension of the Sharpe ratio that, instead using total risk, use beta or systematic risk in the denominator. As such, this is better suited to investors who hold diversified portfolios. By applying these metrics, investors can assess the performance of each ETF not just on raw returns, but in terms of risk-adjusted return and performance related to the broader market. The Trainer ratio and Sharpe ratio help to understand how well the ETFs are compensating investors for the risk taken, while Jensen's alpha provide insight into the ETF performance beyond what is expected on risk profile. Next, Hung will continue with the performance metrics.
Thank you, Hiếu. My name is Hung. Now I'm going to talk about the performance metric. According to the Sharpe ratio result above, MVOL has the greatest value of 0.527, which suggests that it offers the best return when considering the level of risk among the three ETFs. OZR exhibits a Sharpe ratio of 0.411, indicating commendable performance, but marginally lower risk-adjusted return compared to MVOL. Also, AUMF exhibited the lowest ratio of 0.234, indicating that it provided the least favorable return when adjusted for risk during the specified time frame. Furthermore, the MVOL outperformed other investments in terms of Trainer measure, with a high score of 0.080, indicating superior return compared to its market risk. OZR once again achieved second place with a Trainer score of 0.065, suggesting commendable performance after accounting for systematic risk. Ultimately, AUMF is currently positioned at the lowest rank of 0.060, indicating that it has generated lesser return related to its market risk level. Now, Christian will talk about the conclusion. Thank you.
Recording in progress.
So in conclusion, we analyzed three ETFs, which are MVOL AU, OZR AU, and AUMF AU. We checked the diversity levels, which has revealed their exposure in the market and data relating to their risk-adjusted returns. MVAL, which is fairly diverse and exhibits the lowest volatility and it offers the highest risk-adjusted return. OZRAU is the alternative option with the higher volatility, even though it is the least diverse, it has shown to be performing fairly well. AUMFAL, which is the third choice, and it was the least risk-taking ETF, hence why a lower expectation of return. In conclusion, we would collectively recommend buying the ETF MVOL for the long term due to their performance in 2021 of January and January of 2024, in addition to the highly diversified portfolio with a manageable risk and positive performance and return. The remaining slides will be our appendix. Thank you for listening.